Good morning. Last time we started to talk about demand for labor and what's meant by marginal revenue productivity of labor and marginal expense of an input. Today we are going to talk about demand for labor in case of competitive market and non-competitive market. In case of competitive market, we are going to talk about it in the short run and in the long run. And then another point. So this is number one. Number two, policy. We are going to talk about some policy applications to the labor market, such as taxes or imposing taxes or giving subsidies to um, employees. Okay, let's start with the first part, which is short run demand for labor when labor market and the product market are competitive. So what's meant by competitive market? When we are going to talk about the competitive market means that all producers and sellers are price takers in the product market. And with respect to labor market, all employers are wage takers. So this is what's meant by competitive markets with respect to labor and capital market. What about the word short run? Short run means that the firm can't vary its capital stock. So just increasing production will depend on increasing number of workers employed. So short run means capital is constant. And this just for simplicity that we have only two factors. Later on, we are going to assume that there are more than two factors in the production of any commodity. So in the short run, only employment can be adjusted. Only employment of labor So this means that the decision of the firm in order to increase workers will depend on the marginal product of labor. So let's take an example. This is number of employees, and this is total cars sold, for example. So this is the number of units. and this is marginal productivity of labor. 0, 1, 2, 3, 4. So this means as the firm increase the number of workers employed from 0 to 1, total production of the firm increases from 0 to 10. As the firm adds one more worker, total production of the two employees together is 21 units, and so on. So now we have to calculate the marginal productivity of labor. Marginal productivity of labor is calculated as a change in total product divided by change in labor. So it's change in total product, which is 10 minus 0 divided by 1 minus 0. So it's 10. 21 minus 10 divided by 2 minus 1, which is 11. 26 minus 21 divided by 3 minus 2, which is 5, and finally 3. Finally 3. As we can notice that after a certain level, marginal productivity of labor is decreasing. And this is known as declining marginal productivity or diminishing marginal returns. So we have one critical assumption. That as capital is constant in the short run, so if you are going to add an extra worker, an extra unit of labor, marginal productivity is positive to some extent. Marginal productivity is decreasing and positive to some extent. Or in another words, this means that as capital is constant after certain stage or certain level, increasing or hiring one additional worker will cause an increase in output or the firm's production, but at a decreasing rate. Marginal productivity increase, marginal productivity as labor increase, output increase at decreasing rate, or marginal productivity decrease, it is the rate, it's 11, 5, 3, so it's a decreasing rate. The change or the addition is going to decrease, and positive. This is known as law of diminishing marginal returns. So law of diminishing marginal returns means as employment expands, each additional worker has a progressive smaller share of capital stock to work with. Once again, as the firm is going to hire more workers, so the share of each worker related to the capital stock is going to decrease, and as a result output is going to increase but at a decreasing rate. So what's the profit maximizing condition to labor demand? We would like to move from profit maximizing to the condition, or this is the main objective of the firm, and we would like to identify how to achieve this profit maximization level. At the same time, what's the number of units of workers that have to be employed to achieve this level of profit maximization? Profit will be maximized when any further unit, 1 unit change in labor, have a marginal revenue product equal to marginal expense. So the profit maximizing condition is that marginal revenue productivity of labor equals marginal expense of labor. As we said last time, marginal revenue productivity is the marginal product of labor multiplied by the price of the commodity. This is going to be equivalent to the marginal expense, and as we said last time, marginal expense with respect to labor is the wages. So we can rearrange the equation so that marginal productivity of labor equals wage over price, or real wage rate. This is real wages, and this is the nominal one. So the profit maximizing condition will be marginal productivity of labor is equivalent to the real wage earned by this worker. This can be represented graphically by the demand for labor. This is the employment level, and marginal product of labor and real wage rate. This is the demand for labor, or the marginal productivity of labor. The profit maximizing point is the point at which the real wage rate is equivalent to marginal productivity. The real wage rate can be here or here or here. So the actual real wage rate in the market, say for example, this is W over B. This is the actual. So in this case, the number of workers that will help to achieve or to reach the profit maximizing level will be E node, the point of intersection or equivalent of marginal productivity of labor and the real wage rate. At any wage rate, at any employment level other than this, adjustment should be made in the market. Say for example, as we said, at E node, marginal productivity of labor is equivalent to real wage rate. What about this level? E1. At E1, marginal productivity of labor is greater than the wage rate that prevails in the market. So in this case, firms have to employ less number of workers, as E1 are going to be employed, which is less than E node. But firms can increase profit by adding more workers. So if the firm is going to hire more workers, this will help the firm to increase profits. Okay, once again, firms have have to hire more workers in order to increase profits. So this is not the profit maximizing point. Okay, what about E2? At an employment level of E2, in this case, marginal productivity of labor is less than the wage rate, and the employment level is greater than the profit maximizing level. So firms could increase profit by decreasing labor. So returning back to our assumption or law of diminishing marginal returns. Law of diminishing marginal returns can be represented graphically by the marginal productivity of labor curve or by the demand curve, as both of them reflect the same idea, which is, as you are going to hire more workers, the change or the addition by each one of them is going to decrease. And this is why the marginal productivity, the marginal product labor curve is negatively sloped, or the demand curve is negatively sloped. In this case, we talked about the relationship between marginal productivity of labor and the real wage rate. But in some cases, we would like to illustrate the relationship between the labor demand, or to draw labor demand curve in terms of money wages, not real wages. So here we are going to talk about the marginal revenue productivity of labor instead of marginal productivity of labor. Marginal productivity of labor equals W over B is equivalent to marginal revenue productivity of labor equals wage. Okay, so here we have to use this form instead of number one. So why marginal revenue productivity of labor is declining? Marginal revenue productivity of labor is declining because capital stock is fixed, which means that added workers have less capital or equipment to work with. So to illustrate this graphical, this is the number of workers. In case of marginal productivity of labor, we talked about the number of units produced. But here, we have to talk about total value of units produced. And this is marginal value or marginal revenue productivity of labor. From this schedule, we can notice that as number of workers increase from 0 to 1, the total value of units produced by this worker increases from 0 to 50. And as we are going to hire one additional worker, so total number of workers employed are 2, the production produced by the 2 workers equals 90, and so on. So when we would like to calculate the marginal revenue productivity of labor, it's calculated as a change in total value divided by change in number of workers. So it is 50 minus 0 divided by 1 minus 0 is 50. 90 minus 50 divided by 2 minus 1, which is 40. 110 minus 90 divided by 3 minus 2, which is 20. 5 and 2. So as we can notice that marginal revenue productivity of labor is declining. And this can be illustrated graphical as this is number of workers and this is marginal revenue productivity of labor and wage rate, and this is the nominal wage rate, not the real one. As we said, when number of workers is 1, marginal revenue productivity is 50 to 40. So 1 and 50, 2 and 40, 3 and 20, 4 and 5, 5 and 2, 4 and 5, 5 and 2. So now we connect these points together. So this is the marginal revenue productivity of labor, or the demand for labor. As we said, that demand for labor shows the relationship between number of workers employed and the wage rate, the nominal wage rate. The theory of marginal productivity theory, the marginal productivity of labor, has an objection. Or has one main criticism. It is a theoretical concept. Actually, it's very sophisticated to be applied in real life. So economists who are against the idea of marginal productivity theory said that it's theoretical. We cannot apply this in the real life. You cannot determine the actual addition by each worker alone, whether in terms of number of units produced or the value of units produced by each worker. Also, we can say that with fixed capital stock, it seems that adding labor wouldn't add to output at all. It's just workers take their turns in using the capital. So this means that capital are going to be used for number of hours. So instead of hiring one worker to work for, say for example, 20 hours per day, so we are going to add more workers, but the total number of hours that's gonna be the machine is gonna be used in is 20. It's not going to change. So this means that output is not going to increase anymore. What about demand for labor in the long run? In the long run, firms has the ability to adjust input in whether capital or labor. So there isn't any fixed factor of production. So the profit maximizing condition in this case, in case of short term, where as we have only one factor of production, we said that marginal revenue productivity of labor is equivalent to wage rate, or marginal product of labor multiplied by the price is equal wage rate. But in case of long run, all factors of production are gonna be varied. So this is number one. And with respect to capital, it's gonna be the same. Marginal productivity of capital multiplied by the price is equivalent to return or cost of capital. And this is number two. We can rearrange the equations so that price equals wage divided by marginal productivity of labor, and the price equals cost of capital divided by marginal productivity of capital. So this means that the profit maximizing condition is wage divided by marginal productivity of labor is equivalent to cost of capital divided by marginal productivity of capital. So this is the profit maximizing condition. Wage over marginal productivity of labor means added cost or additional cost or marginal cost of producing an additional unit of output when using labor. And this is the added cost or marginal cost of producing an extra unit of output when using capital. So in order to maximize profit, the firm must adjust its labor and capital inputs so that the marginal cost of producing an added unit of output using labor is equivalent to the marginal cost of producing an added unit of output using capital. So what's going to happen if wage increase? If wages increase, adjustment will be made to the use of labor. As wage increase, this condition will not be satisfied. Or in other words, wage over marginal productivity of labor is not going to be equal to cost of capital divided by marginal productivity of capital. So in this case, firm will have to cut back the use of labor, or labor is going to decrease in order to increase marginal productivity of labor and return back to the our condition, profit maximizing condition. Or in other words, wage increase, we would like, in order to keep this condition, there is no change in this part, wage increase. So we have to increase this value to return back to the equality between the two parts or the two sides. So in order to increase marginal productivity, we have to decrease number of workers employed. So this is the first option. Number 2, each unit of capital has less labor working with it. So marginal productivity of capital is going to decrease. So instead of change marginal productivity of labor, marginal productivity of capital is going to decrease. So this is wage increase, and marginal productivity of labor is constant. And C is constant, and marginal productivity of capital is going to decrease. So then we are going to return back to the equality condition. This is known as scale effect. Also, the firm can substitute capital for labor. So as wages increase, we are going to find a substitute for labor, which is capital, and substitute capital for labor. And this is known as substitution effect. If we have more than two inputs, so the condition will be the same, which is wage over marginal productivity of labor equivalent to cost of capital over marginal productivity of capital equals cost of any additional factor. Say, for example, R over marginal productivity, say land, for example, return cost of land is rent, marginal productivity of land, etc., equals, etc. So the condition is the same, whatever the number of inputs that are gonna be used in the production of the product. This is the case of competitive market. What about monopoly? Monopoly in monopoly in the product market. Monopoly means that we have only one seller in the market, or products, this producer is price maker, not a price taker. But with respect to wages or the labor market, employees and employer are wage takers. So this is monopoly in terms of product market alone. So as we said before, that the profit maximizing condition is when marginal revenue productivity of labor is equivalent to marginal expense of labor. In case of monopoly, marginal revenue productivity of labor equals marginal productivity of labor multiplied by the marginal revenue, as the marginal revenue in case of monopoly is not equivalent to the wage rate, the price of the commodity. and marginal expense of labor is the wage rate. So we can write the equation as marginal revenue divided by the price of the commodity multiplied by marginal productivity of labor equals the real wage rate. So this is profit maximizing condition in case of monopoly. Do monopolies pay higher wages? Actually, yes. Monopolies pay wages that are higher than what are paid in the competitive market. As the firms pass monopolies, at the monopolies firms are going to pass the costs to the consumer. Any additional cost is going to be covered by the consumer, so there is no problem to pay a higher wage. At the same time, paying higher wages allow the firms to employ or hire workers who might be more attractive or more skilled workers. So this means that if you would like to answer this question, yes, they pay higher workers, higher wages, as costs will be incurred, the additional costs will be incurred by the consumer, and this allows them to hire more skilled workers. Okay, now we are going to move to the last part of our lecture, which is the policy applications. We are going to talk about two main applications, which are payroll taxes and subsidies, wage subsidies. Payroll taxes are taxes that are paid based that are imposed on the wages or the payroll. Imposing a payroll tax will cause a shift to the demand for labor. So this is the initial situation. This is demand for labor, D node, and this is S node. Point of intersection is point of equilibrium at E node, and at wages, W node. Now the government is going to impose, say for example, it's lump sum tax, it's not as a percentage, okay, which is equivalent to X. So this will cause a shift of demand for labor to the left. And this is like an additional cost to the firm. We have to differentiate between three different cases. Who is going to bear the burden of these taxes? If taxes are going to be imposed, or who is going to bear the burden is the employers, so this means they have to pay wages plus taxes. And if this burden is gonna be borne by the employees, so the actual income received by the workers will be wages minus taxes, or it can be like a percentage paid by the worker and percentage paid by the employer. It's like a mix. So what is the difference between the three cases? Say it's gonna be paid or billed by the employer. So what wage rate in this case will be higher than the equilibrium wage rate by the value of X. So in this case, the firm has to employ E2, which is less than the equilibrium level of workers employed. If it is gonna be paired by the employees, so the actual value that's gonna be paid by the firm is W naught minus X. So it will be E2. But actually, it's somehow like a sharing between employer and the employee. So we have a new equilibrium point at the point of intersection of the new demand curve and the supply curve at W1 and a new employment level, which is E1. So actually, imposing payroll tax, it's not gonna be paired by employer alone or employees alone. It's gonna be a share. A portion will be paid by the employee and a portion will be paid by the employer. And as a result, the the equilibrium level of workers that is gonna be employed is going to decrease from E node to E1. What about subsidies? Subsidies means that the government is going to give the employers an additional money, or allow tax credits to the employers, or give them cash payments. Let it be equivalent to X as well. So in this case, the demand curve will shift to the right instead of to the left. Thus creating pressures to increase employment levels, and the wages received by this will cause increase in wage rate and increase in employment level. So in our lecture today, we talked about demand for labor in case of competitive, non-competitive markets in the short run and in the long run, and finally, two main policy implications for which is related to demand for labor, which are payroll tax and subsidies. This is the end of our lecture today. Thank you and see you next week.